How are we? Thanks a lot for tuning into Wednesday's webinar. There we go. It's got a new ring to it, Wednesday's webinar. Thanks a lot. If everyone could just let me know that you can hear, audio's working well, you can see, and all that, and we'll get on with the day. So I'm actually really excited by this one because I think this could be one of the best webinars that I could have put together for you guys. I've had feedback over the years about that was a great webinar, this was my favorite one, or whatever the case may be. But today's topic is something very important. It's just getting back to the basics, and I think that sometimes it can be hard to, remain focused on, the fundamentals as to, what you're investing into, especially hearing a lot of noise out there regarding sorry, just 1 second, guys. I'm just gonna, it's a bit hot in here. I forgot to tell them to put the aircon on. Sort of get the aircon on. Yeah, and I think going back to the basics of, building a large-scale property portfolio. I think most of the people that that follow me, follow my work, follow what I've been putting out for the last, 15 years or whatever, are mainly here because of property stuff. So I'll talk about macroeconomics, I'll talk about weird stuff that's happening in the world, but this is the fundamentals of, building financial freedom, building financial independence is, building that portfolio and building wealth through property. So today's agenda, I'm going to be looking at, the fact of, one property won't be bringing you financial freedom, how much you need to get started into property investing, when to buy certain types of properties, what sort of properties make a good foundation portfolio, how everyday people can sort of, get ahead from building a portfolio. So I know a few of you guys in here, are very seasoned investors. I know that some of you guys here may be just getting started with your investing journey. So yeah, lots of things here to learn for everyone. So obviously, a lot of people just say, hey, I want to buy a property. I want to get started in buying a property. What property should I buy? And I actually had a chat with someone about this yesterday. Hey, I just want to buy a property, want to get started. That's what my goal is. And I'm like, well, that's good. You want to get a property, but what's the end goal? And they couldn't give me the answer of what it would take them to get to the end goal. And what's important to get to that end goal is, firstly working out what that is. And, you can go buy one investment property. It could be a great one. It could give you, $300 a week. It could give you $500 a week. It could give you $1,000 a week. But, one property, doesn't matter if you're in some exclusive part of Sydney, probably most likely will not get you to retirement. So I like to always sort of break it down, reverse engineer, what it is that I want to do, and work out the steps that I need to do in order to get there. So this is my favorite sort of scenario here, right? I think everybody should be striving to get 100 grand a year worth of sort of income to replace their job, right? Some people will be earning 200 grand a year, some people will be earning 50 grand a year, but I think 100 grand is a nice round number that we can all sort of work to and all sort of relate to. So looking at, I was going to go back a sec, looking at 100 grand a year, what does 100 grand a year look like? So if someone's on 100 grand a day, you'd most likely be, waking up at 7 o'clock in the morning, brushing your teeth, hopping on the train, going to the city, whatever work looks like for you. You're selling your time. You're going to have to get up 3 days a week, 4 days a week, 5 days a week, 6 days a week, perform the tricks to then go and get paid a salary for being able to be compensated for that work that you do. So 100 grand a year is no different than $2,000 per week worth of income. So basically 100 grand divided by 52, let's call it 2 grand just for the fun of it. How would you get to 100 grand? So looking at my first option, I've talked about this a lot over the last, decade and a bit in map sessions with people, and I talk about it quite commonly out there in public, but sometimes it's hard to really, visualize it. So if we look at, 100 grand a year, that's 2 grand a week. If you had 7 properties to rent for $300 a week, that would get you to $2,100 per week. 2,100 per week divided times by 52 is about 109,200 from memory. So yeah, you need about 7 properties that return $300 a week. So if you think that you are going to retire off one property and that's going to get you to retirement, you're not going to get there. You need to work out specific numbers around, what do I need to do to get, where is it I'm going? If you need 150, well then $300 a week times it by 10 will get you to 150. So you can scale this as small or as big as you want it to be. You could just be, okay, when I get to 3 properties here, 3 properties will get me to my desired goal of $900 a week, 50 grand a year. You can scale it as big as or little as you wish it to be. So I guess looking at simplistic form, 7 properties at $300 a week, 2,100. 7 properties with the average purchase price of say 200 grand. I'm just being very basic here and breaking it down to its most simplistic form. $200 a week, 200,000, times it by 7 is $1.4 million worth of property. A lot of you might be thinking, okay, that's great, Nathan. You're sitting here with your nice slideshow and telling me to go buy 7 properties. I can't even get one. How am I going to afford the deposits for each of them? How am I going to come up with $1.4 million to pay them off? I guess in this option, that would be you need to buy 7, work out a strategy to do that. I'll get to that a little bit later on this evening. But buy the 7 at 200 grand a piece, then work out how you're going to pay off those 7 properties at 200 grand a piece, and save up that $1.4 million. And for most investors out there, it's buying a property, then it's working hard, saving money, paying off that debt. If you had to pay off $1.4 million worth of debt, you'd have to earn $2.2 million worth of savings, because you'd be extorted from the government or the ATO to be having to pay that off. So pay the tax, sorry. So it's a big hard task to do that. So option 1 is a very entry level. The minimum that you need to get 100 grand a year would be 7 properties that you need to get, which I think is easy. I see it happen every day. But a lot of people look at me and go, well, you say it's easy, Nathan, how can I do it? So we'll have a look at that a little bit later on. Option number 2, which is my more preferred sort of method, and that is that you could buy the same 7 properties, but instead of just buying 7, who wants to buy 7? That's not enough. Let's go and buy, the slide deck didn't work tonight. I don't know what's going on with the slide deck. So option 2 is that you buy 14 properties. So instead of buying just the 7, you buy another 7. So like option 1, you're ending up with $2.8 million worth of asset, not 1.4. If these properties were to double and go from 200 grand to 400 grand, then you would sell off 7 and pay out the other 7, which I think that's where my error is. You'd sell off 7, but you still have the other 7 here that is retained. So in that scenario, you'd buy $2.8 million worth of asset. That'll double. That'll go to $5.6 million worth of asset. And with that $5.6 million worth of asset, you would sell off $2.8 million worth of, which would be 7 properties at 400 grand a piece, and eliminate the initial debt. That's a much better strategy than option number 1, but it would involve getting to 14 properties, obviously. But the other part to that I don't like is that throughout the last 14 years or whatever it's been of me doing this business, I've never had anyone call me up and say, hey, Nathan, I'm so happy I bought a property in 2010, and then I sold it in 2011. I only held it for a year. I bought it for 200 and I sold it for 300. I made 100 grand. Happy days. I had people do that, but looking back, they've got their tails between the legs, because they're like, they know that property that was at 200 grand is now worth 600 grand. So people don't call me up and say, I'm so happy I sold a property. They're normally like, I wish I had have bought more. I wish I hadn't have sold the property, so on and so forth. So buying 14 and selling off half doesn't really stack up for me. So my thought would be, here we go. My my slides are working on this one, right? So my option 3 would be like the option number 2, which would be to buy the 14 properties. Have the 14 properties in the portfolio with a rental income of 200 grand purchase price, 300 bucks a week. Let's just run some numbers. A 4% interest rate on 200 grand, borrowing the whole amount, that is, that's 8 grand a year in interest. You might have strata fees or council rates and stuff like that. Strata fees, 2 grand. If you have a house, well, then you're paying building insurance, probably 2 grand anyway, so it negates each other. You'd have real estate fees of say 1,000 or 1,500 bucks a year. You'd have all these different things. You'd probably be neutral cash flow. A 200 grand purchase, 300 bucks per week would be neutral cash flow on that property. So if that was neutral cash flow, you've got 14 properties. They're all owned. You've got loans attached to them. They're doing their thing. When you come back in 1 year, 2 year, 3 year, 5 year, for those of you that have the properties already and you've got them rented, tell me that your rent hasn't gone up in the last year. If your rent hasn't gone up in the last year, you need to be calling me and getting me to manage your properties, because everywhere throughout the country, doesn't matter where you're sitting, rents have gone up. Doesn't matter if it's the darkest, dingiest corner of the country, rents have gone up. So if your rents go up by 10 bucks a year, 20 bucks a year, 30 bucks a year, you know, they all add up. So on year 1, I think I've got a little, I think I've got a little slide on this. So I'm going to go to the slide and show it to you and run through it. But the main thing is to acquire the assets. That's the first thing. If you only have 2 properties, you can't retire on 2 properties. If you have 3 properties, you possibly could, but you need it on a scale. So most people are focusing on, okay, let's buy the property and make it positive cash flow. Let's buy the property and, you know, add a granny flat to it. Let's buy a property and do whatever it is to focus on the cash flow. In your acquisition phase of your portfolio, you shouldn't be focusing on those things. You should be focusing on building up this asset base. You need to have the war chest of assets that are going to be able to get you to where you want to be. So I'm going to go to my next slide, which you've got lots of flicky things that are popping up. I've got 2 screens here that I'm watching this from, right? So this one here is just a bit of a, let's play it out, right? Let's say some of the properties are 150 grand, some of them are 200 grand, some of them are 250K. You could have them all at $200,000 purchase prices, but just let's say that they're 150K, some of them 250, 100, whatever. Let's say you got 14 properties, it's 2.8 million. Let's just assume it takes 10 years for these properties to double. That's being very conservative, right? I've got investors and I can see that your names are here that have bought properties in the last 12 months, 24 months that have doubled, right? I'm just saying in 10 years that they double. So if those properties go up from, 2.8 million to 5.6, that means that your net worth position has gone up by $2.8 million. If they just go up by 10% per year on average, that means that you've added to your net worth position at $280,000 a year. You could be going to work and earning 50 grand a year, 100 grand a year, 200 grand a year. Your assets are going up at a far greater rate than your earning capacity. That is the most important part that I think anyone should be striving to achieve. I remember in a lifetime gone by, I used to be called in on TV all the time. I actually had a call today, right? I've got to get back to my friend from news.com, Aidan. He's messaged me to something, some contribution to media. But I used to go on TV all the time. And I remember once I had a chick, her name was Edwina Bartholomew, and it was an Andrew O'Keefe bloke. And they were asking me these questions on the weekend sunrise. And the lady had a question from Koshi that was there, and he always wanted to bait me. And he wrote in there something about debt, and aren't you scared about having $20 million worth of debt? I had about 20 million worth of debt at the time. And I said, no, I've got 20 mil, I'm fine with that. And she goes, but what about if the property market crashes? You'd end up with all this debt and no property. And at that point I laughed. I had nothing else to say. I just laughed. And I said, my portfolio was worth about 50 mil at the time. And I turned around, I just laughed and I said, I've still got 30 million bucks, right? It had nothing to do but laugh. And this chick was like, oh, and the Andrew O'Keefe bloke was there, and he laughed as well. He's like, this guy's a smart ass, right? He's got 30 million bucks. And it was sort of like shuffling the papers, and it's like, okay, let's go to sport now, right? And I got off the stage, and there's all these cables all over the floor. I wore my thongs because I don't own shoes. I just wore my thongs, and it says on the door, no thongs. It actually says on the set of Channel 7, no thongs from the Sunrise set. Don't know why. And walking over the cables, got out, and I pulled my phone out, right? And I looked at it, and all my friends and stuff have been like, mic drop, boom, right? That chick got owned. And what I remembered at the time, I wasn't that I was being cocky. I just was like, hang on a second, right? Don't try and put words in my mouth. These guys love doing that stuff. And I realized to myself, I was about 30 years old at the time. I'm an old man now, I'm 37 years old, but I was 30 years old at the time. And I remember thinking to myself, like, since the day I was born, my wealth as a person, as a human being, has been $1 million a year since the day I was born, right? At that point. And I thought to myself, I couldn't even contain my bodily fluids at that point, right? I couldn't eat, I couldn't walk, I couldn't do anything. So if I spread what I'd done over 30 years of my life, I couldn't have ever earned a job. What job pays $1 million? And to be a CEO of some ASX listed company, but you know, those things are very few and far in between, and all the things that are there, it's just not going to happen. So I realized that at that point that my wealth was created far greater than anything that I could have earned as an income. So most people are focusing on, oh, let's save a latte at, you know, $3 a day, and let's do this and let's do that to try and save. Yes, saving. I remember the days I'd eat for $1 a day, I'd staple my socks together. Right, I was like the biggest tight ass you'd ever found, right? I used to take the coupons off the front of Macca's and say, who wants to go? I'll go get the lunch, guys. Don't worry about that. And buy one, get one free cheeseburger, whatever. I was that dude, right? But that got me to a certain level. But then I realized that there was a bigger picture, and I was playing in 2-dimensional. I wasn't playing in 3-dimensional. I wasn't playing in 4-dimensional. I'm not playing in multi-universes, right? And that's, you know, the mindset shift on that journey. And I think, you know, as you, you know, build wealth, you need to look at the bigger picture. And if you can get to a position, everyone's worried about interest rates today. Everyone's worried. And when I say everyone, that's like 95% of people are. If you understand that property is not a property game, if you understand that property is a finance game and it's the banker's game, you will understand that who cares what happens for 6 months. So the interest rates have gone up over 6 months, 2%, big deal, right? It'll hurt some people, a lot, right? The people that have to pay their mortgage, right? I outsource many things in my life, right? I leverage everything. People say, how do you do it all? I leverage, right? I have great people that do great jobs. I've got great things that do great things. I leverage paying my mortgage. I don't pay my mortgage, right? I leverage paying my mortgage to my tenants, right? I leverage paying my mortgage to my tenants. And what I mean by that is that I'm not paying it. My mortgage might be $200 a week, but I've got $300 coming in from the tenant that pays out that mortgage, and there's $100 left over for me. So understanding that your goal should be whatever you need to do, and then reverse engineering that, you'll see that, you know, if it's just $2.8 million, one day you, like most of my investors that are here in the comments that are writing messages and stuff, right? They go, oh, I had a guy, right? He's one of my investors. I won't give his name out of that. He may or may not watch these things. I haven't seen his name, and he's not even in the country. He's overseas. He works abroad. He's a expat from Australia, and he messaged me and he said, I actually remember having a chat with this guy and where I was. I remember these things are a bit weird like that. And I remember chatting to him. I was actually walking around my backyard. I live on a big farm. And he said he wanted to get a portfolio that gets him like 150 grand a year. And I said, look, I think we can get 10 properties in a year. This is what we do, 1, 2, 3. And I explained it to him on our map session. And he goes, okay, cool. If you can do that, that'd be great. He said something like that. And I said, look, we'll just get you 10 properties. And he settled a property the other day. I sent him an email saying, congratulations, you've just settled another one. You know, do you need anything? Is there anything I can follow up for you that? He goes, Nathan, I just want to say thank you. I spoke to you last year in October, and it's not October yet, it's still September. It was the last day of September. And he goes, you told me I'd get to 10 properties in a year. This property was my 10th settlement. He goes, I thought you were full of shit. He goes, I couldn't understand how I could get there in that period of time, but you had the confidence, and that's sort of what led me there. And yeah, looking at it, when you realize that your assets, it's all a mindset change, right? It's a shifted mindset. When you realize that if you got $2.8 million, that adds up very quickly, right? This guy got to 10 properties in a year. I've never had this conversation with him. Hopefully, if he's watching, he's like, fuck, I've got $2 million worth of property. I've got 3 million, 4 million, 5 million, however many million it is worth of asset now. It's like that asset base, once you've got the 10, 15, 20, those assets just go up in value, right? So if you bought them well, if they're well placed, they've got good growth potential, they won't double overnight. Sometimes they do. One might double. This one from 150 might go to 600. This one at 200 might sit at 250 for the next 5 years. They don't all go up in linear format, and they don't go up every year. I've got investors. I spoke to someone the other day, and they said they had 3 properties. I said, oh, tell me about your 3 properties. They're great. You know, we bought them back in 2015, 7 years ago. And these things have tripled in value and doubled in value. And he's like, I sold one of them. And I'm like, fuck, like you sold one of them. But sometimes people don't see. I was like, why didn't we get to 10? He's like, oh, just, you know, life got in the way and, you know, whatever. And sometimes people sit there and go, oh, it's been a year. I couldn't get equity out. It didn't double. It's not for me. I'm going to sell it. And like, it's probably not for you if that's what's happened, right? But people won't look at it from like a 10-year approach. They won't look at it a 5-year. You're playing a long game here. Interest rates, they could go up for 6 months, but it's not going to affect me. I've just ordered for my tenants' rents to go up. They're paying for it. I've outsourced the mortgage. I'm outsourcing the revenue. As an investor, I'm managing revenue. I'm managing cash flow. I'm treating my investing like a business. I'm not treating it like, oh, well, you know, I'm scared. I'll watch the news, right? Those guys are imbeciles. I know. I've been around them, right? I'm looking at the long term. So 6 months worth of interest rate rises, I'll, you know, might lose a couple of bucks here, but I know for shit that I'll be picking it up tenfold at the other side. I've got the assets. If you don't have the assets, you don't have the ability to push up the rents. You don't have those things. So collecting the assets, 6 months worth of interest rates going up, 12 months worth of interest rates going up, that's 12 months out of 360 months of a mortgage, right? A 30-year mortgage is 360 months. Who cares about 12 out of 360? You've got to look at the other 200 to 348 months of your mortgage. It's a bigger term picture. So when you look at your portfolio and go, hang on a second, I'm holding 2.8 million, that in 2 years could go from 2.8 to 5.2. It could go to 5.6 in 10 years. Who knows when it's going to be, right? Half of those properties could double, half of them may not, then that might take another 5 years. Main thing is if you've got the asset, if the rent today is $300 a week, right, you've got a neutral cash flow position. If you can just push that rent up next year by $10, $20, whatever, I'm just equating here on a $300 mortgage, not even a rent, not even to double in 10 years. But if the rent doubled in 10 years, that's $300 a week positive cash flow. If it just went up by $15, right, which is only 5% per year, which is very, very comfortable, right? That's very, very conservative number. There's $150 positive cash flow. If you can get 14 of them and push that rent up, that's 109,000 anyway, right? You haven't sold the asset. You still retain ownership of the property. When you sell a property, you lose any future rights to it. You have to be slugged with tax. You don't own that asset anymore. You don't have any rights to future cash flow, any rights to future growth. It's all gone out the window. But if you can buy 10 properties, 15 properties, however many properties you can buy, hold on to those neutral cash flow properties. The inflation, and the reason why I am so fixated on macroeconomics and inflation and what's happening out there in the larger market as a whole, I know that those assets will be inflated away because the money is losing its value. I know that the cash flow from the rent is getting inflated away. This is so freaking conservative. It's not funny, right? I see rents doubling. It could double easy in 10 years, right? This is 10 years at going up only by 50%. What happens if your rent goes up you buy a property for $250 a week and it goes up to $300? That could happen. That happens most of the time when we buy a property, they go up by 50%. But that's how you get the cash flow. So if you're looking to get 100 grand a year, you want to build a base of assets and then use those assets to derive and squeeze that milk out, which is, I'm thinking of with the cows and on the farm, right? But you want to have those assets that you don't want to go kill the cow and eat it. You can, but you can have you go kill the chicken, you don't get no more eggs. You can take the chicken's egg, hatch it, spend the time, energy, and effort, hatch that chicken, get yourself a whole new chicken, right? How many chickens do you need to stay alive? Who knows, right? But that's how I look at the portfolio. So any questions about this before I go to any other slides? Because I feel like this is, the biggest and most important thing as an investor you should be looking at. Got a few questions here. Whilst you're typing them in, I'll come and have a look at them. Sarkis said, "How you doing? Doing well. Bit crook. Got a bit of a nose at the moment." Oh my God. Thanks, Emma. David said here, what's a good percentage to increase my weekly rent? I haven't increased it this year. Just depending on where the property is located, what the properties are. I always want to go and look at recent properties that have rented, how many others are on the market. I want to think if I'm the tenant and I cop a $20 increase, what am I going to think, right? There's no magic percentage of what I should be doing. But it's like, I want to be looking and going, okay, if I'm at $300 and there's nothing under $350 for rent, and my property's probably like the $350 for rent, if I push it to $340, the tenant gets the shits. They ain't going nowhere because they can't rent anything else in the market. If they move out, well, then I'll push it up to $350, $360, $370, get an extra $20, $30 a week then anyway. So it's really market dependent. So yeah. Saka said, "Hey dude, Dad's 80-year-old. He's got 100 grand plus cash at the moment to do with. What would you do so we don't lose it from inflation?" So that's the tough one, right? You're asking me what you do with an elderly person's money. I get very awkward around that because there's no room for them to screw up or anything like that. So the importance of, if you're 80 and you've got 100 grand, this is no financial advice here, guys, because this one could border onto that. I'd want to look at the liquidity of it. I want to look at the cash flow. I'd want to look at it keeping up with inflation. That's probably more of a question for offline before I answer that one. So just flick me an email and I'll come back to you on that, Sarkis. Chris said he's got 10 chickens now. Great. I've got 6, and one of my mates today asked me if I wanted 4, so we're going to have 10 as well. So we'll be equal. Eden says, do you just pay interest only on the properties? That's a very good question. So when I've bought my properties, I have paid interest only for the first few years on those properties. If it's interest only for 5 years, great. I can pay extra off if I want, but if you're contracted to pay principal and interest, then you're stuck. If you have it where it's interest only to start off with, let's say it's $300 a week rent today, and you can push that rent up to $350 in the next 2 or 3 years. When the interest only period finishes, the rent has risen and you can pay the debt down using the extra cash flow. And that's what I'm personally doing. All of my properties are principal and interest. They've all turned to principal and interest. Haven't had any. I've got loans now that I'm getting, which are very different type of loans. They're very commercial loan. They're like 12 month, 24 month. They're like bonds more than a loan. But those things are very different. But most of my loans are principal and interest and paying themselves down now, but I prefer that they're not, but I can't go back to the bank and change it. Tommy said, chicken in the context of property is classic. I'll try and keep it fun. Nadine said, why can you purchase property now cheaper than 10 years ago? Very good question. Depending on the market, like property markets are not all linear. So if we look at where I was buying years ago, I was buying properties in Mount Druitt that were cheaper than what they were 10 years prior or 7 years prior. I remember buying properties in 2011 in Mount Druitt that were cheaper than what they were in 2003. Right? That was in Sydney. I remember buying properties in the Gold Coast for 220 grand that were selling for 280 back in 2005, 2007. That was in 2013, 15. Those properties now are 650K. Property goes up, hits a peak and comes down a little bit. I like buying when properties has hit from the top and come back down. So I'm not buying into the Gold Coast at all. I literally, I should be the mayor of the Gold Coast, right? I was the dude in the helicopter when the news had me hanging out the window and going, oh, this one, this one, this one, this one. I was buying 50 properties a month, 80 properties a month for my investors back in the day. I buy one or two now because the market's so hot. I wouldn't be paying 600 grand in the Gold Coast, but I'm looking for markets that have been damaged or at the bottom of their cycle because they're not all going up at the same time. Even in Sydney, I'm buying properties in Sydney for 320 grand at the moment, which used to sell for 400 grand going back 5 years ago. So just, yeah, how I look at it. Lots of questions coming through here. So I'll just go through the last couple of questions and then we'll go back to this presentation and I'll answer the more questions later. So keep the questions coming through. Hello, what is your thoughts on Melbourne? My property manager refused to increase the rent due to the illness. I am not a big fan of Melbourne because of certain things that go on in Melbourne. I think a lot of people that live in Melbourne are not a fan of Melbourne nowadays, but I'm not as in tune into that market. But what I do know is I've actually got one of my staff in the office here who has a property in Melbourne, and her property just became vacant, and she put the rent up, I believe, like 20, 30 bucks a week, 10 bucks, 20 bucks a week. So in every market, rent should be going up. If your property manager, there's different types of property manager there. You could have a pro tenant or a pro landlord property manager. You want to have a pro landlord property manager, not a pro tenant, because a pro tenant one will look after the tenant's rights, pro landlord will look after the landlord's rights. So be very careful with who manages your properties. If you need help managing your properties, I manage thousands of properties across the country. Reach out to my team and we can help you with that. Mel said here, what if all your expenses are also going up faster than you can increase the rents? That is a very important and very good one. Some costs which will be fixed would be stuff like your council rates and your water rates, and for instance, like maybe your landlord insurance and stuff like that. Your insurance policies for building can go up a lot. Your strata levies can go up a lot. And that comes as a part of the cycle that just happens sometimes. You want to be making sure that you're on top of your rents. And Mel, I know your position well. Like, I don't know lots of people's in here position as much as I know yours. Like, you've got enough hooks in the ocean. Like, some might go up a little bit higher than another at a different time. So you've got 20 properties, 10 properties, 5 properties. You're in, like, if you've got a position that's like this, you've got more hooks to throw out there. Once again, not only will the prices go up at all different times, but the actual rent will go up at different times. So just be very diligent on your cash flow and go, okay, whose rent can I put up now? I've got 10 of them here. I can put up 8 of them. 2 of them I can't. I can only put them up 10 bucks. This one here, I can put up 40 bucks. Literally every time I was late to the webinar, I was on the phone to my licensee, Carolyn, in Queensland. Every time I speak to someone, I'm like, what can we do with the rents? Yeah, but let's put someone's rent up, right? It becomes a game. And she told me that one of her tenants in the Southport, it's a development site, there's all these houses in the row I own, and the rent was like 350 bucks beforehand. The rent, it just had a little reno, went up to like 650. They're happy with it. I've got 4 other houses side by side to it. Well, all those rents are going up another 150 bucks. So that's 600 bucks a week, 30 grand a year. Just need to have the hooks in the ocean. So just keep looking at how you can increase that cash flow constantly. I think your Sydney ones that have been a bit stale for a while, those rents should be going up now as well. Just came to mind. Tommy says, Carlos says hello and would like you on the call when you would like your call on when you see interest rates dropping. Look, I've put this out there. For those of you that are new around here, I've been making interest rate predictions. It's not just because I'm reading a crystal ball or anything like that. It's that I'm looking at the data that's out there. I've made lots of videos about it, so I'm not going to go into it too much. But I believe interest rates will start coming down anywhere as soon as March to July next year would be my take on it. So I put my reputation on the line, and 90% of the time I think I'm right with things. So let's just see where we're at. So I'll come back to the questions, keep them coming through, and I will answer them shortly. So here we go. A lot of people might be sitting there asking, okay, what was this? I saw one last question there, and I thought maybe this could answer it. Samuel, I'll answer your question shortly, so just hang with me. I'll come back to you on that one. It's a very valid question. So a lot of people ask me, like, okay, Nathan, how can I buy 14 properties, right? And you might be sitting there with 20 grand saved up. You might be sitting there with 10 grand saved up. You might be sitting there with 50 grand, 100 grand. I just thought I'd do a rough example because I know lots of people in the comment chat actually that have come to me with like 50 grand, 60 grand, 80 grand, 100 grand, and they're at like 10 plus properties in a couple of years. So I just thought 100 grand would be a nice figure, right? So let's assume we buy these two properties, right? Two at 200 grand a piece. You want to make sure you buy them below market value. They've got the upside for growth. They've got a strong cash flow. And with those properties, I've got a bit of a flu at the moment, but the show goes on. So yeah, just bear with me as well. The 200 grand per property, right? Just going to get some water. So 200 grand property, 40 grand deposit, 80% loan, 160K. So your 200 grand, put down a 40% deposit, you've got 100K to start off with, 40K goes to the 20%, 80% was 160. If you have 300 bucks a week rent, let's assume, I don't have a lot of figures in here, like let's assume that the rent is 300 bucks a week. Let's assume your interest rate is 5%, right? For the moment, 5% interest rate, 160, that'd be 8 grand a year. 8 grand a year is about 160 bucks a week. So if you've got 300 bucks a week, 160K loan is probably about 160 bucks a week on a 5% return, 5% interest rate. That means you've got about 150 bucks left over to pay for council rates, water rates, strata fees, all that sort of stuff. So it's fairly neutral. You would need about, on average, calculate about 4%. So you've got a 3% stamp duty, say 1% for legal fees and stuff like that. You're probably looking at, say, 10 grand for closing costs. So this example here, 100 grand, you could buy 2 properties at an 80% loan, 20% deposit plus closing costs for that. So you've bought 2 properties with your 100 grand. How do you go and buy the next 2? Because I know that'll be a question a lot of you guys will be having. It's like, okay, Nathan, like you're a smart ass. You're here telling us to go buy 14 properties. With those 14 properties, you know, that's going to cost me $2.8 million. I'm going to need $500,000 in mortgage, in deposits for that. I need $2 million worth of debt, yada, yada. So the importance of sticking to the golden rules that I've always talked about from buying the properties below market value, etc., is that you can then go back and revalue these properties. Buying a property for 200, revaluing it for 250,000, right? Let's assume you come back in 6 months' time, 12 months' time, 18 months' time, 24 months' time. Let's say that you do this once a year. You put your initial 100 grand in, you come back, pull out equity, and I'm not talking about pulling out equity today and then going back, pulling out equity tomorrow and pulling out equity the year after. Just simply pulling it out once. So you get the property revalued, goes up to 250, 80% loan is $200,000. $200,000 minus your current loan of 160,000 means that you've got 40,000 in equity. So you started with 100 grand, you go buy 2 properties, 40 grand deposit each, 10 grand closing costs, you into it for 50K each, got 160K loan, there we are. You come back, refinance, pull out the equity, you get 40 grand equity, 40 grand equity, you get 80 grand off your 100 grand back. You might have to go and save up another 20 grand. I know that, you know, a lot of people will be like, oh, well, Nathan, you didn't get every cent back out. Well, these numbers can be played at all different levels, right? And I will go through those sort of numbers, but you need to have a model which is Control C, Control V, Control C, Control V, Control C, Control V. There's a price point. People say, why don't I just go buy a property that's a 500 grand property or $1 million property, or so be it. Look, how much do you need to get in? How much you need to start with to get a property? If you buy a 100 grand property, yes, you can still buy 100 grand properties in 2022. 10% deposit, which I don't suggest. I always think 20% is better, because if you go with 10% deposit, there's extra risk attached to it. If you put down a 20% deposit, you go to the bank, the bank approves your loans, end of day. If you go 10%, the bank approves your loan, but then you've got to send it off to a mortgage insurance company. The mortgage insurance company come in, they put their prying eyes and they say, well, you need to do this, you need to do that. And they put all these other terms and conditions around you, which, kind of tie your legs together and, make it impossible for you to move. So if you can use 20% better, but if you're buying a property for 150 grand and you need a 20% deposit, which would be 30 grand, and then say 6 grand for stamp duty and legal fees or whatever, you need 36 grand. If you have a purchase price of 200 grand, you need about 48,000 to settle that property. If you have a property for 500 grand, then you're going to need 120 grand. And this is where the equity pool, and I've put it here sort of like a green zone here, which is my favorite sort of area to be playing the game at. So the reason being is that if you're pulling out on average, say 50 grand equity, if you're pulling 50 grand equity out of a 500,000, you're not going to get your equity back. You're not going to get your deposit back. Apologies, guys. You're not going to be able to get your deposit back. If you go and buy a property for 150, you're going to be getting more than what you put into the property back straight away. You buy a property for 250K, you get 60 grand in, you get 50K back, you've got most of your capital back for that. So I think this is a very sweet spot in and around here to be able to rinse and repeat that process. That's why I always talk about properties like that. You can buy properties more expensive. I buy properties for people for $1 million. I buy properties for, last year, the biggest one was, I think, about $6 million. The properties can be bigger in size, but there's pros and cons to that. So the next slide is, I know a lot of people say, okay, Nathan, that's great. I don't want to buy a unit. I want to buy a house. I want to buy a shop. I want to buy a block of units. So, some of you might be sitting here saying 14 properties. Why don't I just buy a block of 10 units and I can be done with it, right? There is a very big problem from doing that. And I'm going to take you to my next slide here, right? When you're buying a house, let's say you buy a $200,000 house or unit or townhouse, you need the $48,000, which is explained over here, right? I've just put it to the next level. If you were to go and buy a block of units, if you were to go and buy a commercial property, you would need to put down a 40% deposit plus the closing costs. You can't go back and pull your equity out. So let's assume you want to go and buy $1.2 million worth of property. That could be 6 properties at $200,000 a piece, right? You could buy, let's say you've got $500,000. That'll only buy you $1.2 million. You could buy double the amount of normal residential property because the bank's position is more favorable to a single residential house, single residential townhouse, single residential unit. So when you're looking at a block of units, if you've got more than 3 units in there, you become a commercial loan and the bank looks at you very, very differently. So you want to keep it to a residential standard. Also, it brings a risk. The risk is, let's say, for instance, you've got a block of 10 units, you spend, I don't know, $2 million on a block of 10 units. It's all great. It's all in one block. You don't have to pay strata fees, but you have to pay land tax. You have to pay all the building repairs. You have to pay for the insurances. Those things add up that you have to put back into your bottom line. If you've got a strata manager, if you look at the strata fees, really, your strata manager probably only gets about 200, 300, 400 bucks per year from that. The rest of it is things that are there to keep the property operational. So within looking at that position, if the market was to double tomorrow, would you rather have a $1 million portfolio double to $2 million or a $5 million double to $10 million? A lot of people try and buy a block of units at the start, but when you look at it, you have to put in double the amount of capital. So it means that you get less of an asset or less of an asset base. But then if you got into a position and a spot of bother where you had to sell off that property, you don't, if you have 10 singular properties, you can sell one, you still got 9. If you got one big block of units and you have to sell that block of units, you end up with nothing. So you've got to ascertain risk and manage risk along the way. Going and pulling equity out of a duplex, right? Let's say you got a two-bedroom duplex. When the bank goes out to the value, there's only 1 duplex in the street or 5 in the suburb or whatever. They don't have anything to compare it to. They're going to compare it to a 4-bedroom, 2-bathroom house as their closest comparable. If you have a house in the street or a unit in the street, they can compare it to anything else. So you need to look at the equity perspective as well as the cash flow perspective. So I think blocks of units and and villas and shops and all those sorts of things are very, very crucial. But I think that once you've got the asset base, the foundation portfolio laid, that's when you can go and start playing with these things with confidence. I've got a slide a little bit later on that I'm going to bring your attention to as we move through these slides. So I'll get to that shortly. Keep the questions coming through though. Where are we? How blue collar workers, so this was something that was asked in, and it was just, you know, something I thought I'd answer. You know, how can average people, like, surely most people would think, I actually showed Carolyn this, she may not like me talking about it. I won't go too deep into the conversation I had with her yesterday, but Carolyn from office, I was talking to her from my marketing team. There's lots of staff, hundreds of staff, and people have got the same names in different departments and stuff like that. But I was talking to this person in my office, and I was talking about actually some of these properties and some of the things we're putting slides together. She's like, damn, man, like I never realized that this is how cool and how easy it is. And, you know, my staff learn, like they become investors. They start investing and all that sort of stuff. And, you know, it's a lot of people, Carolyn actually said to me, she goes, I never heard, it was actually those slides, it was about 5 slides back that I showed with pulling out the equity and how that works. She's been doing my videos and my social media for, I don't know, on the team for like a year, 2 years, something like that. And she's like, now that she's really excited by it, she's like, damn, I didn't realize how easy that is. And they never told me at school about this, right? They never told me this about school. They taught you at school how to be a good, obedient slave. They told you how to pay taxes and, you know, how to fit into the system, but they never told you how to control your life and be able to live life on your terms. And I think for most people out there will be sitting there thinking, you know, shit, Nathan, you say go buy 14 properties, like it's like so obvious and so easy to do. And it can be scary for people, right? It can be scary because the last time you bought 15 properties was probably never before, right? So changing that mindset, the person I was at one property to having 3 or 4 was a very different person. The person at 10 was very different than 3 or 4. The person at 20 was different. I had to keep changing and growing and changing my mindset and adapting to the person I had to become to be able to control that. I was talking to one of my mates today, and he owns a business, and I was saying to him, mate, look, your staff might be, he asked me, he called me for some business advice and stuff, and I said, look, you need to, like, I walk around like the poorest bloke out, right? Like, people will get envious of you because you're driving in a certain car, you're doing something different, but it's just human psyche. So you need to evolve as a different person. I remember the time when I was like, wow, yeah, look at the keys, this is my Bentley, right? Let's take some photos. I think even my profile pictures of Bentley on social media, I just haven't changed it. I don't care about the car like that, but the person to grow, to get to the next level, you need to evolve and develop yourself. And I think, you know, a lot of mindset out there around, you know, I just come from a simple family. I just came from, you know, Western Sydney. That was my background, right? I only earn 50 grand a year. I only earn 80 grand a year. I'm telling you guys, there's hundreds of people. We're actually having our B.Invested annual Christmas party. It's been a while since we've had one because of all the lockdowns. Every time we go do one, it gets locked down. But it's in November. So if you're one of my investors, make sure you turn up to that. But yeah, there's going to be a room full of people, hundreds of people that have just started off with one property, or they've been on 50 grand a year income, and they've got, you know, a dozen properties. They've got 5 properties, they've got 8 properties. So, you know, it's important, I think, you know, most people are sitting out there thinking, I need 200 grand, I've got to buy my principal place of residence first. And then once I bought my principal place of residence, then I can start investing. I didn't get my principal place of residence until I got 120 or 130 odd properties. But then I pushed up maybe 30 or 40 my rents by 10, 15, 20 bucks a week. And I made my tenants pay for me to live in a better part of the neighborhood, right? And, you know, I'll tell you a story a little bit later about how I just bought my new dream house of $4 million that came from selling off some of my little original properties that I bought. And it's just using those properties, right? Most people are thinking, okay, I need 200 grand, I need 500 grand, I need to do this to get investing, right? I just showed you guys a slideshow ago. Where is it, right? You can get into a property, you got 150K property, 36 grand. It's not hard, you know, I'm saying it's not hard, right? Like, 24 grand, 10 grand, 14. These numbers here aren't $200,000 to buy a $1 million unit in Sydney, right? This isn't to buy a, an $800,000 unit in Melbourne and the Gold Coast. Like, this is just getting started with investing. If you buy a property for 150 and you revalue it for 200 grand, you just made 50K, right? If you have 10 properties at 150K and they go from 150 to 250, right? It's only 100 grand, but you got 10 of them, there's $1 million, right? That's how you get your dream house. That's how you get your holiday house. That's how you get all the cool things of life. You build a system that's going to work for you. So I think most people, just come from a basic background. Don't sit there and go, hang on a second, I've got, $1 million in my pocket, right? They've only got 20 grand, they can sell their car, right? I've sold my car so many times over, right? I've got 2 new cars at the moment, right? And I actually just went and found all my old classic cars and got them out and polished them up and all that sort of stuff. But I was driving a $500 car for a year, right? A year, a $500 car, a fucking Mitsubishi Mirage. You see 6'4" Birch, you hop out, fucking hands the size of dinner plates, and here he is, in a pink Mitsubishi Mirage, right? All my tradies, I had a Great Wall Ute I was driving around for a little bit. I had to send it to Queensland, and I was driving this thing. I was waiting for my new cars to arrive. I've got no issue with it, right? If I have to sell a car, I've sold my car. I remember rocking up to auction. I was probably number 6 or 5 or something like that. I was like 20 years old. I was hungover, right? I was like, fuck, I'll buy this thing. I want to buy this townhouse, whatever. I bought this townhouse. And I was like, okay, well, I've got no deposit now, right? I've got no deposit. How am I going to pay for this thing? I looked at my car and I was like, I've got a new Rexy, right? I've got a new Subaru Rexy. I bought it cash. And I was like, it was only like 3 months old. I was like, fuck it, I'll sell that thing and I'll take the cash and I'll drive a $2,000 car. I did it, right? So there's always a way to get in, right? It's just, how are you going to get your foot on the ladder so you can start, working your way through it? You might not have any money. You might have your own house and you go, oh, well, I can't afford to buy a property, right? You might have 100 grand equity. You might have 200 grand equity. You could have 4 properties. Most of my investors that build these large portfolios, they're not coming with, oh, here's 300 grand, mate. People don't have cash. No one has cash. Go and ask your friends and go and ask your family who has $500,000 cash. You won't find it, right? People don't have cash. They're not that liquid. They might have it in an offset. They might have it in some equity. They might have it in some shares, right? People don't just sit there with cash, because no one became rich holding cash, because the cash is losing its value more than anything, right? So find the opportunity to be able to go and push forward. If you've got a house, you might have 50 grand equity. You might have 200 grand equity. You might have 500 grand equity. I was chatting to someone beforehand. They're going to get 20 properties in the next 2 years. First time I'd spoken to them, literally just before I hopped on to the webinar, it was a 6 o'clock app session with me. And looking at their position, right, like, people don't just sit there and go, okay, here's all the cash. It's, leveraging their position and moving for a better day. I think the most important thing to change a class, right? Like, I think it's important. I see these like coins here, they're like fake money, right? Like, they look like they're silver, but you see the silver's falling off. They're really copper underneath. All the money's fake. That's why it loses its value. I'm going way off track here. Right? But stepping up the ladder, right, and moving to a different class, it takes a different version of yourself to do so. And I think having the plan to go, okay, it's just like a business, right? You set up a business plan. If you wanted to map out what your journey should look like, you should go and set a business plan around your goals, a business plan around your property investing journey, and going, okay, this is where we're starting from today. This is the steps we need to get to the big fat jar of cash, right? What hurdles do we need to do to overcome that? What does this jar look like? What does this start off with? And what steps, who do I need to be able to get there? What steps do I need to take? Just like a business, treat your investing like a business. That's probably my main sort of steps on how to be able to get successful as, just a blue collar person. So started from there, eh? I feel like Drake started at the bottom. Here's what a property portfolio should look like. So just looking back at that other chart that I had beforehand, I want to share that again, right? If you got 14 properties, average purchase price 200 grand a piece, if they just double, it's $5.6 million. You now have $2.8 million of equity. If you're sitting there going, Oh, I've got no access to money. Well, fucking find a way to access the money. You can go and work. Literally, if you bought 14 properties and that went up by $2.8 million, $2.8 million divided by 40 years, that'd be like 80 grand. That's someone's whole working life, right? That you've just made in your part-time as your hobby, right? If you could go and sell them, get extorted by the system, pay heaps of tax, all that sort of stuff, or you can just go to the bank and say, hey, can I just borrow a lazy $1 million? Right? Oh, what do you want the $1 million for? Oh, I want the $1 million so I can go buy another $5 million worth of assets. Oh, okay, cool, right? I make it sound easier than what it is, because the bank and the finance is the biggest pain in the ass along this journey. And that was the question that Samuel asked beforehand. I will get to that. I promise I'll get that answer, and I'll come back to that. But looking at the rents, right? Let's say you got 14 rents and they're all at $300 a week. That's 4,200, right? If you push those rents up just by $15 per week, which could quite well be double, right? That goes from 4,200 to 6,300, which gives you $2,100 per week in surplus cash flow. If that doubles, that means you've got 4,200. You haven't sold the properties off. You haven't paid down the debt. You've got 100. I'm just using here very, very basic, right? Like so simple. Like this is so conservative number, right? Just $150 a week across 14 properties, $109,000 per year, right? $109,000 a year. I'm going to take you to something that a lot of people are not thinking about today, right? A lot of people are not thinking about this next one. Very, very interesting, right? Imagine you have that $2.8 million property portfolio, right? And let's assume that you've got a loan for 100% of that, right? I remember having this chat to one of my staff, right? I'm not going to mention their name. This chick, I'll mention it anyway. It's Linda, right? Linda from my office. She was the chick that was on the Koshi one day, and he grilled her as well and said, oh, you're an idiot for having these properties, right? Blah, 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 right? I remember when the interest rates came down from like 7% or 6%, and they went down by like 3%, right? And I said to Linda, I was like, Linda, you're $3 million worth of loans. Each 1% they come down, that's 30 grand a year better off you are. If your interest rate comes down by 3%, that means you're saving, look at the numbers here, right? 4.5% is 126K. If the interest rates just come back down 1%, yes, you've had to pay extra money, right? But your rents have gone up or are going up in line with that. When interest rates come down, the rents aren't coming down. So that's extra cash flow in your pocket plus the rental. So if interest rates were down on a $2.8 million mortgage by 2%, from 4.5 to 2.5, if you've got a portfolio of $2.8 million worth of debt today, and when the interest rates do start coming down from their cycle, which we're on at the moment, which is tightening, and when we go back to a quantitative easing period, if they come back down by 2%, that means you're going to be $58,000 better off. If you've pushed up your 14 properties, right, that we saw over here, the 14 properties, you push rent up by 100 grand a year, plus then you slap on the extra 58 grand a year, you're now looking at 170 grand a year passive income. It's treating your numbers like a business. People aren't looking at it like that, like you guys are, right? That's why we're here. That's why we're spending our Wednesday night listening to sick Birchy here. When I say sick Birchy, I didn't mean like sick, like fully sick. I meant like sick with the flu, right? Talking about, this sort of stuff. That's what we need to look at. We need to look at the numbers. We need to look at how can we keep tweaking and refining. It's not going to be perfect and all linear as great and go, yeah, interest rates are falling down and rents are going up constantly. There's cycles that we go through, but it's managing that cash flow like a business manages their cash flow. That's the important part about it. So going to, this is about, the guide of building a multi-digit property portfolio that we're talking about today. Why does a property go up in value, right? Most people sit there and say, oh, it's the area that's going up, it's being regenerified, or they're putting in infrastructure, there's a new school, it needs to be near the train station, all this sort of stuff, right? That's what most people think it is. And sometimes, if we look at the Gold Coast, people are moving there, right? People are moving there because they don't like down in Melbourne, they don't like Sydney, they just like the Gold Coast, right? And that's put a lot of demand on that. Sometimes it could be infrastructure. There's a new freeway going through us, linking up logistics, right? I was looking at a line the other day, a trade line, which has been built, and they're expanding it. And this trade line connects a regional area with 3 capital cities, right? And this regional area is a port, right? And, it's got a lot of infrastructure, right? And these areas are going to go nuts over the course of the next decade, right? That is true in a lot of circumstances, but I think that's very boring and very, that's a part of why properties go up. Other areas is because of stimulus packages. The reason why Sydney house prices went up, units didn't go up because we didn't have immigration coming through. Units didn't go up because we weren't stimulating the economy with giving people, hey, if you buy a shitty 30-year-old red brick unit, we're going to give you $30,000 to buy that. That isn't what happened. The market that took off was new homes being built, new apartments being built, things that are overcooked, overvalued. The reason why that got popped up is due to the fact that all the tradies now have a new Hilux and have a new Ford Ranger and have a Raptor, have a fucking a Chevy, right? These tradies are getting, and they're going to spend their money. It's going to trickle around. It's going to stimulate the economy. So follow where stimulus checks are going, and you can start seeing. And when I say stimulus checks, it's not just stimulus checks. It could be interest rates, right? Interest rates have a detrimental effect, pros and cons, right? But let me tell you, if interest rates are going up, it's because inflation is there, right? If interest rates are coming down, it's because the system's destroyed. I am the happiest guy because I see the opportunity from pain, right? Interest rates dropping, certain things happening, stimulus. I know there's going to inflate that bubble and get it even bigger. So look at what's happening out there in the economic world and the financial world, and you won't get that information from listening to any news source out there. You'll get that from looking at your own research and digging deep and finding answers to your questions on that way. Now, I try to share that with everyone on a Tuesday Night Live and through a podcast and through these webinars and stuff like that. The other thing that impacts the property price growth is immigration coming in. So the thing I like at the moment with property is that we had at about, I think, 160,000 people migrating to the country per year. Now, I have a way of explaining things which is very different to most other people out there in the financial space, right? They wouldn't refer to people as tax slaves, right? And I'm very cautious because I had people say that I was racist once because I said we need to import and have immigration high so we can make more tax slaves. What I mean by that is we are all tax slaves. We can't breed tax slaves quick enough, right? So we need to hire them from somewhere else. So when we have migration coming through and we're immigrating people to the country, that helps bring more cash flow from tax checks, right? We're in a position now where the government cannot afford to be paying the debt, right? Your interest rate's gone up, so you need to push up your rents and all that sort of stuff. We need to have more taxpayers because the government's debt of $1 trillion plus all the roads and all the things that they're employing, their debt's gone up in value. So how's the government going to pay? They were taking out bonds at 10 basis points. The government's debt is now 260 basis points or 2.6% interest that they are paying on their mortgage, or even higher, right? So for the government, their bill has gone up 26 times or 20 times or 15 times, however many times, whatever their rate is that they're paying before it now. They need to help pay that somehow. So they need more tax slaves to pay that. We can't breed them quick enough. So we need to have them via immigration. So we're now starting to see the immigration levels have gone from 160 to 200, talks of 250, talks of 400,000. Imagine that if we had immigration at 400,000 people per year, we can't print enough housing for the demand that would be there, right? But it's either that or the government goes broke. They need to keep that up. Where's the problem going to be? The cost of construction has an impact on what pushes property prices up. Market sentiment does. If people are scared of what's happening in the media, if they're excited about what's happening in the media. Seriously, if someone ran out 2 years in the last 2 years and go, oh, I better buy a property, it's doubled in value. I want to buy the property, it's gone up double, it's great, I can see it's had so much growth. That is stupid, right? Buying property in the last 2 years isn't stupid, but if your purpose of buying property is because the market has gone up and you want to be in a piece of that, you're 95% of the people that don't make money out of real estate. If you're sitting there going, okay, the market's turning shit, right? The market's a bit, and this takes me on to the next slide. There's better opportunities out there when the market sentiment is low. So we need to look at that as well. Advantages for buying a property or for property investors during a recession. I'm going to go back to that slide in a moment, but I'm going to answer some of your questions. So keep them coming through. So Samuel said, hey Birch, in order to obtain the said 14 property, serviceability with the banks becomes an issue on two fronts. One, the income to debt ratio and also the individual's borrowing capacities. Banks don't like giving much to a single individual. Could be about 1.3 million before they start turning you away. How do you get around that? I've calculated that in order to obtain the next property without impacting your borrowing capacity, the property needs to be above 13% rental yield. Do these properties still exist? Lots of moving parts in that, right? Just as your property strategy is important, sorry, I just saw on my screen, I'll just quickly jot through. It says strategy there on the screen, right? And I was looking at strategy, I was talking about strategy. So that just as your property strategy is in place, you need to make sure that your finance strategy and your debt strategy, debt to accumulate and debt to retire that debt in the future, you have a strategy around that. And I see a lot of people get stuck because they're just like, I'll buy the 400 grand property that rents for 500 bucks a week. And they're not looking at it going, I can buy a 200 grand property that rents for 300 bucks a week, because you want to keep boosting up your cash flow position. If you have 75 grand a year income, you buy 5 properties that rent for 300 bucks a week, you'll get to that $1 million in property, right? Let's say that 200 grand a piece and you buy 5 of them, that's $1 million, right? You now have 5 properties, right? But you've got 5 hooks in the ocean. You have outsourced that mortgage to 5 tenants, right? So you've leveraged your mortgage. You've taken the mortgage. Yes, I'll take the mortgage. And yes, I'm going to grab this guy over here and make him pay that mortgage, right? You've got 5 sets of tenants now. And if they're bringing in 300 bucks a week, 300 bucks a week times 5, 1,500 bucks a week. 1,500 bucks a week times 52 is 78,000. If you're on 75 grand a year, now you've got another 78,000. So yes, you've got $1 million of debt, but you're now on 150k a year income. So the bank looks at you a different light. And that's why you need to have the strategy to go to certain banks at certain times. So it might be starting off with the big 4 banks. I always think everyone should be using big 4 banks, and this is no financial advice. If there is some commie from any regulator out there watching this, I'm not giving financial advice, guys. I'm just talking random stuff that is factual, and I see on a day-to-day basis, right? But I see that the most successful portfolios are built when someone can utilize the big 4 banks to buy the properties, get the foundations laid, pull out that equity, then take that said equity and then go to a second tier lender. Then you buy the properties in the second tier lender, which they calculate your servicing very, very different. And if you can use that equity from the first batch, use that to buy cash flow properties that are boosting your cash flow, then those banks have less regulation and parameters to play with than the first set of banks. So then you've got a different playing field to sit there and play with. Some people come to me and they're like totally screwed. They're like, I can't buy anything. They might have 100 grand in equity. They might have 500 grand in equity. They might have $1 million in equity, right? They have $1 million in equity, but they can only get out 100 grand of equity. My suggestion would be to go and get that 100 grand. And then with that 100 grand, you could buy a property outright for 100 grand that brings you in 300 bucks a week, right? It wouldn't be a property that you build your foundation portfolio from, but when you buy that property and own it outright and you have a 300 bucks a week on a 100 grand purchase, the bank just goes, okay, 300 bucks a week, there's no loan, sweet, we'll lend 80% of that rent. That income then helps you service to go and get more of your equity out. So there's different strategies in order, and everybody's position is different. You need to speak to the relevant people in order to be able to help you get there. And I sort of guide people with what I do in order to get them there on a daily basis. That's what we do at B.Invested. Hopefully that answered your question a little bit. Nigel said, what are your best thoughts? What are the best parts of the country to consider purchasing? I buy everywhere. I'm not stuck to one geographical location. I used to be Sydney. I used to be Sydney Gold Coast, Brisbane. I am national. I buy in every single little pocket. I know each and every one of them by the back of my hand. Photographic memory really helps out with being able to, hit a little thing out there. So Bradley said, I'm worried about getting into the game of those tumultuous times, great reset and all. Look, not everyone that watches these videos, I've come to the realization, realizes what the Great Reset is all about. And it's, the World Economic Forum, the, Klaus Schwab, there's certain entities out there. When people say Bill Gates is a bad guy, all that sort of stuff, that is the group of people that they hang out with, right? And they talk about this great reset where you'll own nothing and you'll be happy. If you think that you own anything in this world, people don't even own their body now, right? But if you think that you own anything in this world, try not paying your council rates for 2 years, right? They'll come and take your house off you, right? Even if you've got no mortgage. Try not doing certain things. We have access to things in that system. The way I see it is you can be fearful thinking that people will have nothing, right? And the World Economic Forum, they sort of forecast things eerily correct, right? And say these things are going to happen and role play it, and it does come to fruition. You've got to think, are they smart, or are they the ones that are orchestrating all of this stuff? But looking at, you'll own nothing. A lot of people, I think, are taking that in the context that they're going to confiscate off you, but someone's got to own it, right? How will they make no one own anything and take the private ownership away? The corporation, the controlling entities will, via any hyperinflation, people lose things, right? Hyperinflation is not good. I'm so excited by it because I know I've got the assets that are going to be inflated away. I'm scared of it because I do have things that could impact me, right? If I was in a business that deals with stock and stuff like that, I'd be concerned. But I'm in the business of renting out an existing asset that I picked up before inflation's hit and those sort of things. Inflation and a hyperinflation, which we're not going to go too deep into today, would be pushing 50 years of growth into a period of 6 months, 12 months, 24 months, 36 months. If people were at the mercy, it's not that these entities are going to take everyone's asset. It's going to mean that they can't afford to get people. It's like if you watch Seinfeld, right? You don't see an episode of Seinfeld where they're like, oh, I'm going to buy my first home today, right? You never see that. They're like, oh, yay, I've got the opportunity to rent, right? Renting in New York is like buying in Australia, right? So we're going to end up in this world. Someone's going to own the assets, right? And the window's closing. It's getting harder and harder for people to accumulate wealth and for people to be able to play and participate in this game. Our generation is going to be probably the last generation that can be able to go into property ownership. And it might even be very quickly that people can't afford property ownership. And then we're going to start seeing, there will be they call it the landlord, right? You're the landlord because you're the lord of the land. You're buying up all the asset. So yeah, that's where you want to be at. Bradley said, can't help but worry there may be a market crash and new investors may get hurt. Thoughts? There's been talks of a market crash for many, many years, and it's there's people are still sitting there without the assets, right? The opposite, you've got the opposite of holding cash, which is losing its value. I've got the opportunity of owning the asset. Anything could happen. I've never sat here and gone, oh, right, yep, I've gone, okay, we've got a GFC, right, back in 2007, 2008. The opportunity that came from the GFC, and this is something for people with fear, right, as especially good entry into advantage of property investors during a recession. I was able to retire from my job in the GFC. People were scared of their job. I threw my job in, right? I resigned, I quit my job because it's like, I'm earning more for my property. My portfolio, everyone was fearful. People were losing money. People couldn't obtain assets. So they had to drop interest rates, which stimulated the economy. We were in a time like now when interest rates have gone up and up and up and up. As the interest rates go up and up and up, it becomes harder for people to buy. So there's more people entering into the rental pool. More people entering the rental pool means that the rents are going up. But then when they dropped the interest rates, the rents never came down. That spread, which is like what I showed you guys beforehand, is exactly how I was able to retire in the middle of the GFC back in 2008, 2009. Matt asked here, embarrassed to ask considering my current situation, but is there a hope for a 45-year-old guy earning 40K with 80K in cash and no assets? Can I get started in that position, or do I need to address something first? Matt, there's many things that could be, for and against you there. You got 80K, that's great, right? People come to me, they don't have 80K. You got two deposits there, right? The 40K cash flow is a bit of a lower sort of income. I've seen people get 3 or 4 properties on 40K income. So yes, definitely possible. The strategy would be different. Everybody's strategy should be different based on their position, and there's not one size that fits all. If you're thinking of buying a property in Sydney with a house with no eaves for $1 million and getting caught in the mortgage trap, well, then you're going to be in trouble. But if you're buying a property for 100 grand, well, then you can almost buy the thing cash. So definitely there's stuff that you can do. If you want to work through that, you can reach out to my team. Just go onto the B.Invested website, which is B.Invested.com.au/discovery session. So B.Invested, just like the I don't know what you like, the the straight line that goes down, the dash, the one that's where does it sit on the keyboard? The one with the question mark on the keyboard, right? That one. binvested.com.au/discovery session. Go in there, book in a meeting, have a chat with one of my team. Quite often I'll consult with my team just on new people that come through the business and say, hey, Nath, I've got some question here. They know, right? They know. They see people's position. They go from 0 to 20 properties in their portfolio. So yeah, have a chat with them, and yeah, if we can do something to help you, we're here to help. Kylie said, hi Nathan, hope you're feeling a bit better today. Yeah, I'm feeling good every day I'm alive. I think I've got allergies, actually. Allergies is what my problem is. It's not really sick. I was sick last week. With a client that purchased 10 properties in 12 months, was it a matter of refinancing one property at a time to extract the equity and go again? So on and so forth. So keep a 5K property for each buffer. Is there a maximum number of times you would refinance a property to extract the equity out, or pull the max equity out of each property? Look, we spoke the other week about this, Kylie. I've got lots of investors that have done, the 10, 15, 18, 20 in a year or 2 years. I think it's just going to have a bit of water. I think each person's different. Like some people might come in with, 300 grand, and they might be only on 80 grand, right? So they've got the big cash, but they don't have the cash flow to be able to support. So the properties that need to be acquired for that person would be, different to someone that came in with 100 grand cash or 50 grand cash, and they're on 200 grand a year because they need more equity base. So the balance of equity and cash flow, if think about it this way, even if someone had 300 grand cash that came to me, that'll get them 5 properties, 6 properties, and then nothing else, right? Those properties need to perform by being able to pull the equity out and go again. I'm not a big fan of just keep loading and jacking up the equity. I think go pull it out once, use it. You might pull it out twice, depending on what you need. The property is just a vehicle to get you to where you need to be. Wow, lots of questions coming through. So I'll answer this last one for Nadine, and then we'll get back to the benefits of buying property, benefits for property investors during a recession. So Nadine asks, when pulling out equity, you still need to be able to service it. How do you do that if you don't earn enough? If you don't earn enough money, that's one thing. But then the someone just wrote here / whatever it's called, right? You can earn the money, right? But there becomes a point where you can only earn a certain amount of income, right? You could earn 50 grand, 100 grand, 150K, 200 grand, 300 grand, right? But there becomes a point where you can't earn any more sort of income, right? But your properties will generate a greater income. So I've a great client of mine that's got nearly 20 properties, and it was her 4th property I bought for her. I could see that she was going to get stuck at number 6 or 7 with the big 4 banks, and I wanted to get her there. The situation I saw was that I don't want to get him stuck at number 7. I want to get it stuck at number 10 or 12. I want to push that down a bit further and get the greatest potential at that bank, right? So what I did was I found a shitty property, and I say shitty property because there's nothing sexy, nothing flash. It was a $59,000 property, and I think it rents for about $450 per week now. It was renting for like $200, $250 at the time. And the reason why I suggested that she buy that property is that she'll get to a point when she gets to number 7 that she'll have to go and earn an extra 20 grand a year. To earn that 20 grand a year, she'll have to go and get a second job, work an extra day a week, take on more hours, whatever the case may be. But from her buying that property that gives her 20 grand a year, the debt is only, 50 grand on a 60 grand property. With that debt, that's irrelevant, right? That's like credit card or a car loan compared to the bank, right? But the income is an extra 20 grand a year income. So we've used the property to artificially increase her income. So then the banks find her attractive to keep lending to her. So you need to find ways to make the banks attractive. As I said, throughout this webinar, I've said it a lot lately, and I think it's very, very important. This is not a property game that we're all playing in. This is a finance game. This is a banker's game. We need to know how the banks work. A lot of people will, how many people would be sitting in jail right now? This is way off topic, but this is funny, right? How many people would be sitting in jail? They've gone to the bank, put a balaclava on, held up a gun. They probably don't do it nowadays because no one's got any money. But they're, give me all your money, give me all your money. Everyone sit down, right? Sit down. How many people would be in jail for robbing a bank? What do they get? They get like 10 grand, 20 grand, 50 grand. They get arrested. They go to jail, right? Idiots. I hope they're not watching this and seeing that I'm calling this in the back of H Division out in their, the jail. But, they're robbing a bank, right? Give me all your money. When you understand that the bank is designed to give you the money, right? What is the purpose of the bank? The bank's purpose isn't to go, hey, bring your $100 in, we'll give you 100. They're doing a service for you by employing the staff to do that, right? The purpose of the bank is to lend you money and give you the money and then get you to pay them money, right? That is their business. So all these idiots that go and rob a bank go, give me your fucking money, blah, blah. That's stupid, right? The bank wants to give you their money. That is their business, is to give you money. So the thing is how do you get the bank to give you the money? What sort of conversations do you have to give you the money? It's not of aggression. It's not of go to the bank, go give you all the money, bang, 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 pow, 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 blow a few holes in the wall, make everyone dance. That isn't the purpose of the bank. The purpose of the bank is to go, okay, we'll give you the money. So what you want to do is to understand the parameters of the bank. And that's sort of why I tell everyone all this weird stuff I talk about. No one else out there talks about it because they don't understand it in the property space. They're trying to sell you a property or something, right? If you understand how the bank works, you can walk in and you can rob the bank with a felt tip pen, right? They'll give you all the money you want. Just sign the documents. You need to know how to position yourself. It's like, okay, guys, 1, 2, 3. When I deal with people and I deal with people in those sort of positions, I've bypassed the bank now. I don't want to deal with the bank, right? Go on through the bank. I want to become the bank one day. It's like Neo in the Matrix. Jump into the Matrix. Become the Agent Smith, right? I've gone through that. So when I talk to these people, they're not discussions like it'd be like having with a bank. It's like, how can you position yourself to be attractive to get the money? It's like going on a date. Think of swiping through all those lenders like a Tinder date, right? I'm full of laughs today. I don't know why. It's pretty funny. I'll come back to some more questions. Keep the questions coming. And let's look at the advantages for property investors during a recession. First and foremost, when you're out, let's say you buy a property in 2020, in the second half of 2020, not the first part. The first part of 2020 was amazing, right? People were scared. They weren't on the street. No one was driving. People were throwing properties away. I'm going to go in and I'm like, I don't know what's going to happen here, right? But I want to get more assets. I can see the dropping rates. This is going to sort itself out. Most people were shitting bricks. For the first, say, 4 weeks in January, I was probably a little bit concerned. But after that, I knew it was all a scam. Looking at that period in the first 3 months of 2020, that was great, right? I'll be like, look, everyone's closed down. We're going to have a big recession. How about you give me the property? No one else is here. No one turned up open home. Everyone's shitting bricks. I'll give you 200,000. No, it's 250, but I'll give you 200. Oh yeah, that's fine. Thank you very much for the opportunity, right? They printed all this money. They made the biggest boom we'd ever seen. They've created the biggest Ponzi scheme around this money printing cycle that they've got. And then suddenly, every poor bastard's now got money because the bank will give it to them, right? The bank will give anyone the money. So you've got everyone there. They've got the government grants. They've got $50,000 worth of grants. You've got buyers galore. You go to an open home, 50 people turn up to open home. Who would want to go put an offer in? I remember talking to a mate of mine at the Gold Coast. I talked to a mate of mine on the Gold Coast, an agent, and he's like, mate, I've got this great property. It's got termites in the roof. I've got 4 buyers on it. I'm like, oh, well, then the buyers pull out. I'll buy it and I'll give you 30 grand less, right? And it was really shit. I was just buying it for land value. He goes, mate, they're offering me 20 grand over with no finance, no pest and building. They don't even see that it's got termites, right? So literally, people don't know that there's termites in the property. people are buying a shit box. They're not doing their due diligence, not doing their protection, right? I lost so many deals through this market because the market was just so hot. There was heaps of buyers. I'll just do whatever. I don't have finance, right? Who cares? We'll sort it out. Sign the contract. That's what you had to do. So would you want to participate in that market, or would you want to participate in a market where the real estate agent rings you back and says, well, why don't you put an offer in, right? So in a market, when we're in a recession or a softer market, you're seeing less competition out there. That is number one best reason for buying through. All the idiots wait for the market to go up and they're all getting FOMO and shit, right? Good luck to them. The vendors have fears. So just as the buyers have fear, the vendor has fears. The vendor's thinking, oh, interest rates have gone up. I need to get out. I need to do whatever I'm doing. I better sell. Let's get out of this deal because of, whatever the case may be. So the vendor has fears. You need to use them to your advantage during this time, right? It is exciting. Right? I'm more excited by this time than what I am from a hot market. Hot market's lazy. It's stupid. It's like you've laid all your seeds into the field. The farmer comes and they don't go and lay seeds in the off season. They go and cut their crops and they're doing what they need to do. This is the market that you want to be sowing those seeds. You get a higher rental return in a recession, right? Very fact. Go look throughout history. You have the ability to raise the rents during the recession. You can increase your profit that way. Stimulus packages come from a recession. They don't give you stimulus packages because we've got a high inflation. They don't give you stimulus packages because the economy is good. They give you stimulus packages because everything is dying and it's falling apart and they need to throw the kitchen sink at it. So a lot of people are looking at the parameters and they've got it all wrong, right? They've got it wrong. They're looking at a recession going, oh, well, this has gone wrong, that's gone wrong. No, when the recession comes, they throw everything in it and it causes the next boom. That's why you have these cycles, all these clowns out there. They go, oh, you've got a clock and all these sorts of things. They're all fluffy things to talk about, right? Understand the game board. You see what happens in that game board. The boom comes after the recession. If we're going to a recession, pick up all that shit on sale, take it through. We're going to see a boom. So yeah, you got better negotiation power. You got more opportunities. Yeah, that's just my thoughts of the benefits of for property investors during a down. You wouldn't go sell your properties. An idiot would go and sell their property. I'm not saying people are idiots if they're selling a property, right? But if you had the opportunity, people go fear the, oh, interest rates have gone up. Oh, what happens if it gets to 20%? Oh, what happens if I listen to David Kochie on the news and he tells me that I should do this, right? It's like, that's stupid, right? Have a sound plan. If you have a sound plan, all that stuff's just noise, right? You're fighting, you're dodging bullets like Neo in the Matrix, right? He just walks through them, he drops them because that's what it is. So next one, how to avoid going broke in the property game. Educate yourself. Understand. People don't know what they're doing. They just go, oh yeah, property sounds great. Oh, Bitcoin sounds great. Let's buy all this stuff. Let's buy all the coins. Oh, Bitcoin went up. Let's buy this new scam over here. Oh, I don't know what I'm doing. It's like Blind Freddy could tell you that's a scam over there, right? I'm gonna say crypto scam. I love crypto, but like there's heaps of scams out there, right? But people just go, oh yeah, whatever, right? So know the game that you were playing, right? First and foremost, educate yourself. Get as much information. There's so many people out there trying to sell you their crap. They're trying to sell you their wares. They're trying to sell you a property. They're trying to sell you a course. They're trying to sell you the next hot doodad. So know what the game is, and when you know the game is, go, cool, that's what I need to do. Have a plan to get yourself there, which is very, very important. Most people don't have a plan. They don't have a strategy. It's easy to get scared if you don't have knowledge and you don't have a plan. Very easy. Leave your emotions at the door. Most people get screwed up from emotional decisions. Emotions, a fear, is fear an emotion? Yes, fear causes weird things to happen. Ego is the worst one, right? I love recession, right? If we go back to the benefits of recession, right? People lose their egos. People have an ego. I'm the fucking best. I can do this. I can do that. It's like, well, how's it going down there now, right? The ego gets you killed. So any sort of emotion will get you hurt. So not minimizing risk. I talk about all the strategies that I do to minimize risk. I'm all about risk minimization. from day one, the first step you take, it needs to be removing the risk. You're not gonna, if you leave all risk on the floor, you know, there's something for you to trip over on. You need to remove the risk. Each step, remove the risk, clear the path, remove the risk, analyze the risk, assess the risk, understand what the risk is. People think, oh, it's less risk, buy 1 block of units, have 10 in a row. Well, we just talked about it before, and put down double the deposit, you can buy half the amount of asset. Buy a block of units, you're gonna pay for all the same expenses, you're just paying them yourself, you're not paying a strata manager to pay them on your behalf. Look at the risk, you have to sell that one asset if you get screwed, not sell 1 of 10 and keep 9 of them. So understand what risk is. People don't understand the concept of that risk because it's way out of whack. Chasing hot opportunities, hot strategies, hot topics, hot things, the thing of the day, the doodad, the shiny thing. I'm out of breath, I keep talking for a couple of hours, I've got congestion. You know, oh, I went to this course, they're telling me to do Forex, they're telling me to do crypto, they're telling me to do shares, they're telling me to do a development property, they're telling me how to buy options, they're telling me how to get rich quick over here, they're telling me to buy commercial property. Well, go and do that, see that happens, right? If you have a strategy, I easily look at stuff, I'm like, fuck, that's got a lot of money, but if I stop and pick that up, I'm gonna get slapped in the head over here, I better not stop, that was interesting, I'm gonna keep walking. Have that clarity with your strategy, to have a plan in place to be able to get there. Very, very crucial. I just help people from identifying that, creating strategies, creating plans, and then assessing the deals. And, you know, I guide people. There's heaps of shit. I don't even know half the stuff I do. Sometimes I feel like I'm a counselor to people. Sometimes I feel like I'm a, you know, a coach. Sometimes I feel like I'm, you know, helping smuggle Mexicans across the border. You know, it's all different things people hit me up with, but it's, you know, there's core things that we do here that that is important for success. This one here is a topic I don't really like talking about. You know, how to pay off that mortgage in 10 years, right? A lot of people want to know about that, and I think, you know, for a lot of people that is, you know, something they need to be guided on. You need to have a good relationship with debt, right? Some people are bad. They need to have a relationship with God, right? People need to have, someone said about chickens beforehand, how to pull things in, right? And the analogies, right? You need to have a good relationship with God. You need to have a good relationship with your family. You need to have a good relationship with your friends. You've got to have a good relationship with your colleagues. You need to have a good relationship. If you want to be successful with finance, finance is debt. If you want a good relationship with money, you must understand that if there's light, there's dark, there's good, there's evil, right? If you understand that there's money, right, as you believe money is, like dollars and currency and all that, you need to understand that debt is the other side to it, right? Money is debt. You need to have a good relationship with debt to be able to understand and, you know, have it as a part of that process. So, you know, people fear debt. They go, oh, no, I'm not going to touch it. Well, you're pushing away the opportunity. You're pushing away the potential. If I had $1 million of debt, right, and I came into $1 million today and it landed in my bank account, what would I do when I look at that debt? Most people would just sit there and go, I've got $1 million, I've got $1 million here, I'm just going to pay off that debt. I live debt free, right? There's so many people out there say live debt free, it's the best thing to do, right? I want cash flow, I want assets, I want opportunity, I want options to be able to do what I want. If I need to dump 50 properties, I want to make sure I can dump 50 properties, right? If I dump the 50 properties, have cash, well then I've lost the properties, I lost all those opportunities, all those options for the future because I've sold my right to being able to do that. So most people would go, okay, earn $1 million, pay off $1 million worth of debt, end of story. I would look at that as a big risk because, you know, $1 million property, $1 million debt, pay out the debt, you've got $1 million property, doubles to 2 million. So what? Everything else is inflated around. With that same $1 million, I could just keep that debt, buy another $1 million worth of property, got $2 million worth of asset. That doubles, goes from 2 million to 4 million. I'm 3 million better off than what I was before. I do have the debt attached to it still, but then I can use the cash flow from the new $1 million worth of asset and use that cash flow to pay out the interest on the other part of the asset. So that relationship, very, very important. So you could work forever and pay off your mortgage, right? You could have let's say you got a $500,000 mortgage, right? I think that most people have a $500,000 mortgage would be an average for the mortgage in the country. So you've got a $500,000 mortgage. You then go and work hard, pay off 50 grand a year. You save up 50 grand a year for the next 10 years. You can pay off that mortgage, right? Saving 50 grand, you have to earn 80 grand. If you're on 100 grand, you ain't living, right? So a lot of people will just look at it from that perspective, that we need to pay off the debt from doing that. For me, I'd just go and buy another $500,000 property, like option number 2 of beforehand. Buy $500,000 worth of property, wait for that thing to double, sell off that property, pay out the debt on the other one if you wanted to do that. So you could buy double, sell it off. Most importantly, I'll just be looking at cash flow. If the mortgage is costing me $1,000 a week, well, I want to make sure that I'm going to buy enough assets that will pay that off over the next 10, 15 years. So build up an asset position that will pay down my debt position. Then you've got the chicken and egg. You've got the taco that stands and the taco that folds. Increase your cash flow. You're going to have to work harder, earn more income, or you can buy properties to earn that income and pay down the debt. Just as an example, right, of doing this, just a bit out of breath, guys, just a bit out of breath. I just had a property that I bought in 2012, so 10 years ago. I paid $300,000 for it. I just sold it for 1.1. I made 800 grand profit on it. I used that 800 grand as a deposit to buy my dream home. I bought the thing basically cash. When I say a deposit, like that's just a 20% component of it. That thing back in the day, people were like, I sent that deal. I bought 30 units in a block of maybe 50. It was a developer that got divorced and I had to sell all his shit, poor bastard. Anyway, he would have sold it anyway, whatever he sold it for. I had people to me say, no, I'm not going to buy that property because of whatever reason or whatever story was going on in their head. If I had an 800 grand mortgage, my mortgage on my first property is now worth $6 million. The property, I still own it. That was the first house I lived in. It wasn't my first property ever. It was my first principal place of residence. It's worth $5-6 million. I bought it for 1.2. I owe 800,000 on it. I could literally take that unit I bought 10 years ago for 300 grand, just sold it for 1.1, take the 800 grand, pay out that mortgage if I wanted to. But no, I want to buy another house. So have a strategy for debt reduction at some point. It's important, but yeah, work out a strategy. It's not just go work hard, work like a dog, pay all taxes, all that sort of stuff, and in the story. So when we look at old deals, I'm just going to run through some deals that I've bought previously over the last 10 years. I'm not going to tell you when I bought them and all those sort of things. That could have been 2 years ago, could have been 3 years ago, could have been 5 years ago. This one here, she's looking a bit tired now. This property here, bought for someone, 227,000. Rent on it now is $450 per week. I think that's what it was beforehand, not what it is now. It's 10% yield. That thing there is probably worth about 500,000, 520K now in the current market. So that thing there's doubled. Nothing sexy, nothing flash. It's modern. It's got depreciation. That's in New South Wales, on the beach. This property here is a unit. It's about 10 years old. It is in the Gold Coast, in the heart of the Gold Coast. Purchase price was $183,500. This was about 4 years ago. Just out of water here at the moment. Last little bit of water. So I've got to be quick. This thing here rents for $400 a week. I think it could be a little bit higher now. Current market is $400,000 for this property. So this was a matter of a couple of years. A lot of people said no to these properties. A lot of people did buy these properties back in the day. This one here, this one here is a great one, right? I bought about maybe 150, 200 of these properties for my investors and myself over the years. Purchase price for this one was $240,000. This is just one. Some of them were higher, some of them were lower. Current sales prices are around the 520, 550 to maybe 600. They vary. 240K rent for $500 a week. Yeah, deals are happening, right? At the time of purchasing this, I think it was probably $350 a week rent. Some of these rents now, you're probably getting $600 a week in the area. So If you bought this for 240, it's renting for 350. Okay, neutral cash flow. The property would is modern depreciation, all that sort of stuff attached to it. It's now positive, probably $250 a week, and the property's gone up and over doubled. That's only a matter of a few years. This one here, 199,000. I actually own one in here. Current market value for these, this one here was a 2-bedder, rents for $550 a week. They're worth 600 grand, so that thing's tripled in a period of maybe 8 years in here. My one, I just sold one of mine in here for 440. It was a 1-bedder, rent for like 500 a week. So yeah, cool sort of property. This one here is a block of units bought for one of my investors a year ago. Purchase price 700. Rent for 4,000 per week. You're getting $400 a week times 10 units, 30% yield. Happy days. You can see where it is. You've got nice water here. Very cool location. This thing here, purchase price 3 years ago, maybe 2 years ago, when everyone was scared at the start of Corona, 53 grand. Recent sales now, $160,000. I actually just bought a couple here for some people for 110, 120,000, renovated and unrenovated. Rent on it 220 per week. Happy days. Cool. Just seen a message in my phone. My mum had to go to hospital today, and yeah, my brother just texted me. She's all good, all good. Not from being sick with the flu like me. She had some other stuff, getting old. This property here is one. Okay. Something here, right? This property here is the last of the ones that we had purchased, but I'm about to show you some properties that we are in the process of purchasing at the moment. This one here, just secured today, 137,500, rent for 240 per week, yield of 9.1%. There's not much under $200,000 in this suburb. As you can see, it's a double brick villa. This is a ground floor villa. You can't build a property for 137,500. This one here is in a CBD. It is a 2-bedroom unit. You're buying it in 2022. It is CBD. Nothing sexy, nothing flashy, but very fundamental. Rent for $390 per week, a 10% yield in a capital city. In a capital, when I say capital city, I mean 5Ks, 10Ks to the CBD, right in the heart of the city. This one here, which one is this? Oh, yes. This one here is 318,500. The owner had paid 360,000 for this property, brand new, going back 6 years ago. Rent on it's $400 a week, positive cash flow. This is CBD, like I can't even explain. This is like a city, right? This is like a Sydney 2000 postcode, Melbourne 3000 postcode, or whatever it is, Brisbane 4000 postcode. This is right smack bang in a CBD 1-bedroom unit, proper 1-bedroom unit, plus a study. There's a study there, and you've got a bedroom that's around the back. So deals that are still available out there in 2022. This one here is a townhouse. It's pretty modern, double brick, 215 grand. One just sold on the block for 250, so $35,000, less than something sold 2 or 3 months ago. Rent for 380 per week. It's positive cash flow, about $100 a week. Deals are still out there. If someone had 10 of that property from beforehand, you'd be able to retire, right? Build a basic income straight away. This one here is in, I won't say where it is, but this one here, 165K. Previous sales have been 300,000 in this complex. Rent for 260 per week. This is the price of, like, many years ago. It's like we're hopping in the DeLorean, taking Back to the Future in the DeLorean, and yeah, someone here just wrote that bought one of those units for 53 grand. Just wrote here $235 a week now in that suburb, in that block. So Yeah. This one here, duplex, 330K, rents for $600 a week. Pretty good return. This one here, 735 grand. Rent on it you'll get, it's currently rented for 1,050, but it would get about $1,400 a week for this thing. This one here, interesting number of the price. I didn't make up the price. It's a bulk deal that I just purchased. When you break down the units, it works out to be $333,000 each. I've done a valuation with CBA, and they've come up at $397,500. Purchase price is 333 grand. This is in Sydney, 2-bedroom unit. Very, very, very good value. If you want know more about these properties, you reach out to my team at 1300 367 925. You know how to find us. So yeah, have a chat with my team and we can get you started. I'm going to leave you with that email, and I'm going to go back and answer some of your questions here, guys. So a few questions, I'm going to answer them, and then I've got to go because I am getting out of breath I've literally talked for about 7 hours today. I've been on, my staff booked me back-to-back phone calls all day today, plus our webinar, lots of things going on. So yeah, I'm going to go and hop back on emails actually. So Matt asked, do B.Invested have any employment opportunities available? I employ over 200 staff nationally in all different sorts of businesses. I think I've got maybe about 30 roles available at the moment, constantly growing, got different things going on in all different areas. So if you are interested in recruitment in my business, email address is hr@binvested.com.au. So if you have a job and you want a new job, you want to be a part of my team, I'm looking for people in all different roles, whether it be customer service, whether it be finance, whether it be property management, whether it be motel managers, whether it be, what's a tropical location, running a motel, you have to turn sheets and stuff like that, but you get an accommodation, you get a package where you live on site with the property, lots of cool things for people. So yeah, hit us up. Never know where a conversation will go to. Thanks so much. Your property managers listed on the website. How do I touch base with them? Reach out to my team, send us an email at this email address, admin@binvested.com.au, put in their property manager, and yeah, my team will reach out to you. Just send over your details, where your properties are at, what they're rented for, what the property type is, as much information as we can tell, and then my team will be in touch and yeah, have a review of your property. So if you've got one property, you can push up the rent by $20 or $50 or $100. If you've got multiples, then the more the better, because then you could literally, the reason why I set up property management, I'm really getting out of breath and I'm talking too much, guys, but the reason why I set up property management for is I was unhappy with pro-landlord, pro-tenant real estate agents. I wanted pro-landlord. Some were very, very good and some weren't. And I realized that the difference between someone's retirement is if the properties rent, when I buy properties for my investors, they generally $50 below, $20 below, whatever. $50 below, that's $2.5 grand a year. 10 properties, that's 25 grand a year. That's half of someone's average wage towards retirement that's being robbed from them. So yeah, it's very crucial to have a good property manager on site. Craig says, what are your views on regional investment properties rather than city and metro based? Regional properties, from what I can see, would more often fall within the 150 to 250 price range with returns of 300 plus. I like them, but I don't rate all of them. I need to be seeing value, and I want to be buying them below rebuild cost, buy them below what they were selling for beforehand, buying them below market value. I want to see an upside for potential with heaps of infrastructure. So there's lots of areas that are regional that are bigger than most cities as well. So depends when you say regional where we're talking about. If it's in a town of like 100 or 5,000 people, if there's not a Macca's, an Audi, a Woolworths, I wouldn't even want to really go there unless I'm stealing it. So it depends case by case. What other questions we've got here? Hey Nathan, hyperinflation or stagflation, do you think rents will rise quicker than property values? Yes. We're going through a high inflationary cycle at the moment, and rents are going up higher and higher than they have done for a very long time. So the more inflation, the more your rents rise, all the cost of everything out there is sort of rising. Matt said, hey Nathan, can you go from second tier lender then refinance back to Big Four? Is it possible? What is the strategy behind this? Yes, you need to get your servicing right. You need to get your cash flow right. The reason why the Big Four won't just lend to you is because you don't service with them. You want to make sure that you're putting yourself in a better position to make the bank happy with you. So if you want help on that, you can reach out to my team and we can chat to you about it. So just, yeah, reach out to the team. John said, I can't see the presentation. I don't know. You're the only person that said that, mate. I don't know. Hopefully everyone, else has been able to see it. I don't know what's going on there. Sorry about that. What else we got here? Do I like Andrew Tate? That is a very interesting question, a random one. Look, I don't have a fan of anything. I see that's a fanboy thing happening around Tate. I certainly like a lot of things that he has to say. I don't agree with everything he has to say. I think a lot of things he says is being pulled out of context as well. I think that some of the things he has said has led me to believe that he has been placed there. He didn't just arrive to that position. Someone has placed him there, just like your average celebrity, Bieber, Kardashian, whoever it may be. I think that guy's been placed there, and that is a controlled opposition. So I like some of the stuff he has to say. I don't dislike him. I think there's a lot of value with some of the things he has to say. I find him humorous and entertaining. I've watched, I don't know, maybe 100 of his videos, those quick 1-minute ones over time. And people send me stuff. I find it fun, but I wouldn't, think he's great or anything like that. So, Josh said, well done, Birchie, glad your mum was okay. Hope you get better, mate. Sick with the flu is shit. Yes, exactly. Thanks a lot for the kind words. A lot of people have said, hope your mum is okay. Thank you, Kylie. Thanks for the information. Thanks a lot for time. Thanking you. Hey mate, how much of a buffer would you recommend per property in the portfolio? We want to go all in while we can. I think $5,000 per property is a good rule of thumb. I think $5,000 per property. But if you've got 100 properties, that's 500 grand. You probably don't need 500 grand on 100 properties. You might be able to go, okay, cool, I can spread some more of that. But just what you feel comfortable with. If it's a 20 grand, well, then have a 20 grand buffer there. So it's what you feel comfortable with. I normally recommend $5,000 per property as a rule of thumb. That's if the property is like a 200 grand property, neutral cash flow, all that sort of stuff. Stan said, I wish this was recorded. Any chance? Yes, you're in luck today. These webinars are recorded and you can get them. They'll be emailed out to you tomorrow as well. So you can have a look at them, share them with your mates maybe, go back through some notes and all that sort of stuff. Joe said, bit of off topic, but can you put in touch with a business coach? Want to make sure I get this part right to keep investing. Good question. Maybe there's something we could chat about as well. Like, I don't have any mentors when it comes to business. I ask questions past my mates and they're really, I take their value from where they're coming from. So for example, Ridwan, he runs One Path Accountants, one of my best mates. And he always says, I live my life vicariously through you, right? The shit that I do, he would never do. But I respect where he's coming from. And a lot of the time I'll question it. I'll ask him a question. He'll tell me, no, don't do it, 1, 2, 3. And I'll be like, don't do it because of that. And then I think, okay, if I can address that, then it's all okay then, is it, right? And he's like, no, right? You're pushing yourself too hard, right? He said for me to stop at 10 motels, right? It's probably stupid. I actually just had a meeting. This is way off topic. Had a meeting with a large motel chain. They're like a branding one. And my motels will make up like 10-15% of the whole group. They're all just like franchise mum and dad operators. So I'm a big business to take in there. And I'm like, I want to get to 100 motels. I want to be so big, right? And yeah, with Ridwan, he says, don't do it because of X, Y, Z. And once I know where he's coming from, because he's going to be much more conservative than what I'm at, then I go, okay, I can address that. I've covered that off, ticked all the boxes. If all the boxes are ticked, then I can keep running. So it's good to have a group of people around you, but I've never had a business coach as such. So if you want to have a chat, Jono, just chat to the team and just book in a chat for us. We'll have a chat, and I'll point you in the right direction wherever I can. Text me one day. Probably best to get the team to put it in for a call, and let's have a chat about it. So yeah. I've got ideas, mate. I've got ideas. I like some of your business. I like some of the things around your business as well, by the way. Is it true you can only put up the rent once a year? Yes, there's new laws that have come out that say that you can only put rent up once a year, which is a great opportunity because you can just push the rent even higher at that point in time. So depending on where the property is located and all that sort of stuff, there's different states with different regulations and all that. Stan just said he needs to swipe the windows to see the presentation. Okay. I don't know how this appears on any device or anything like that, but maybe you've got to swipe to see the presentation. Sorry. Yes, so Kylie just said here, the gentleman may be watching this webinar on his phone. He needs to swipe left or right to see both screens. So yeah, I don't know. Apologies about that. I'm not the tech savvy bloke. Chris said, could it get to a point where people can't afford the inflated rents if wages don't rise at the same time in the near future? Yes, that's correct. People may not be able to afford the rents, which will cause another part of the recession, because if people can't afford because their wages and their rents have gone up, they can't afford to live, right? We'll end up in a deep retail recession, and they will have to stimulate the economy. It's like those choose your own adventures and having a flow chart, right? It's like go here, go here. It's always going to end back to more stimulus, because that's what keeps this system alive and floating. John said, all good now. Hi, Nathan. What is the ideal debt to equity ratio across the property portfolio? So John can now see it. He said it's all good. So thanks for everyone for helping him out. It's what I like. We're a community. We can do cool things together, right? Strength comes in numbers. Think about that with your own community, your own friend circles, people that can help you with bartering, and who can grow your chicken eggs, and who can grow your meat, and who can wash your car, and who can do this. They're all things to have in your community. Perfect debt to equity ratio. When I first started, my debt level was 95% LVR. I realized that I could have been smarter if I went to 80% LVR, but I didn't realize at the start. So I've been at 95%, I've been at 80%. The reality of it is that it's whatever you feel comfortable with. I think start with 80%, pull out equity when you can, always keep it around 80%. My LVR now is like 10% or something. It's like nothing. I've got a very low LVR. Bradley asked, where can I download your podcast intro song? I might actually get it put out there. My mate Bilal did that. He's a rapper. He did if you go onto Facebook, it's like rapping KFC, rapping your KFC order. So it's like he goes and orders the KFC as a rap. Subway rap, KFC rap, the train rap. His name's Bilal the rapper or something online. I wrote the lyrics. The middle part of the song was my part, which I didn't end up recording and publishing. It was a cryptocurrency song that I did about 5 years ago, talking about the recession, the depression, the hyperinflation, and everything we see today. There was a lot of stuff in there about crypto. I never published it, but you can't really get it out there, but I could throw it out there for the fun of it. I'm going to actually throw it out. I'll throw it in a Birch feed. So if you guys are on Birch feed, you can get it. I'll throw it out in the next 24 hours or so. Birchfeed.com. I throw a lot of random stuff out there. I talk about things that borderline conspiracy theories, but when you start questioning things, they're not conspiracy. You're just asking general questions. And I put out a lot of the research that I look at, a lot of the notes, a lot of the things that I look at on a day-to-day basis. You can find it at birchfeed.com. It's an app, so you go to birchfeed.com. It's free. You download Telegram app, you enter in your details, you get given the code, you link yourself in the Telegram, you get access to Birch Feed. It's free. So yeah, a lot of people love it. How many properties do I need to own before I can comfortably grow a mullet or a rat's tail? I could imagine you with one, mate. I could imagine you with one. Just do it when you feel like it. Like I'm at a point in my life where I don't need to impress people. I don't need to care what people think. I'm just having fun with my life. Like I have fun with what I do. A real genuine, like I've got lots of problems. Everyone has problems. Everyone has things that are good and bad in their life. But I'm just having fun with it. I just don't care. I thought one day my hair's grey. Like I'm starting to look like I'm getting fat. One day I'm going to look like bloody Cole Sandilands or something, right? And who wants to, be like Cole Sandilands, right? So I just started growing the ras tail. The ras tail's growing long. I grew it, and then it gets plaited now, and it's getting long. I don't know. I'll cut it off one day. I said when I'm going to lose 20 kilos, I'll cut it off. So it's going to stay around for a little while longer, I think. Vincent asked, what about a foreigner's mortgage? As lending is still not available from local high street retail bank for foreigners. Yes, there's different ways to be able to go and get loans for foreigners. There's certain banks out there, Kudos Bank and a few other banks that are out there. So speak to someone that can help you. And yeah. Rick said, actually, I've got lots of questions here that I think I've missed here. Steve said, thanks for tonight. I hope you get better soon and your mother is okay. Thank you. I appreciate it. Unfortunately, for my mum's sake, she is getting old and she is getting frail. So bad things happen, unfortunately. But thank you. And yeah, hopefully she's on the mend soon. She broke a hip from frail bones. So it's really, tough. We've got here, Nathan, thanks a lot for your time afternoon. One of the best webinars by far. Thank you. I actually thought today when I did the webinar, I was like, maybe this could be the best webinar that I ever did. Sometimes I'm like, oh, I'm just going to talk about something I talk about anyway. But sometimes I'm like, wow, like this shit that I'm going to talk about, I feel like there's like people could make a shitload of money from what's about to come out of my mouth. So I'm glad that you felt that way about it. And you said here you're one of the few people who actually take the time out to explain everything, sharing the knowledge and educate everyday Australians. Thanks, mate. Really appreciate it. I appreciate it, mate. There's no awards for what I do. There's no, no one's going to give me a pat on the back and give me, whatever for doing these things. I do it. I've got a cool community. I've got cool people out there. I just like sharing it. What's this one here? There's so many questions here. I've got to jet soon because it's way over 2 hours. What's this last one here? If you had the option to purchase your principal place outright, would you, or would you buy investment properties instead with the current climate? Good question. I like leverage, right? I like cash flow. I'd take the portfolio. Why would you want to own the place outright for? You'd use the bank's money. Like if you can get debt at 3%, 4%, 5%, whatever, inflation is at 8%, right? If you're buying a property cash, you're just trying to save 3 or 4 or 5%, but your cash is losing a greater rate of value than that. So, for me personally, I'd rather take the assets with debt, create the cash flow, and also I'd rather have them all. So I'd rather have the principal place with the debt, and I'd rather have the assets with the debt. I'd rather have the assets with the debt to pay down the debt on the principal place of residence. But I guess it all comes into having a strategy. I'm going to do one little plug here, and that is pushing the slide back. Where are we? A discovery session. Book in a chat. There's a link there. There's your / / whatever it's called, binvested.com.au/discovery session. And book in a chat, have a chat with one of my team, speak about your position. If you want, you can book in for a chat with myself. My team can organise a chat with myself as well. So on that note, guys, I've got to go. I've got to stop talking. Thanks a lot for tuning in. Thanks a lot for being a part of the Wednesday webinar. First time I ever thought about the Wednesday webinars. And we'll catch up shortly. See you back next month. Keep being awesome. Be safe, everyone. And chat soon.